Hey, good evening, everyone. Marty Mazzora here. It's the 10th of October, Friday, 2025, with your end of week update. So, folks, I've dialed up a number of charts for you. We're going to eyeball the ones that we've been eyeballing a lot lately and try to decipher what the messages may be therein. As I expressed last time, we're beginning to see some potential under the surface cracks in the credit market, and we'll take another look at some of the private credit indicators, and I'll give you kind of our thoughts on those. First, though, let's on that topic, and when I say first, I mean first before we get to the charts, let's look at some narrative around that. So this is in our log from yesterday. And essentially what I'm noting for our purposes is just the weakness that I'm seeing in business development companies and private equity stocks. All the while, credit default swap spreads, those are insurance policies, let's call them, against default, in this case on corporate investment grade bonds, that's what we're looking at. And then the high yield spread, and that's the difference in yield between 10-year junk bonds and the 10-year treasury, are not essentially budging off of pretty historic lows, meaning CDS spreads remain tight. That means that insurance remains relatively cheap in an historical context, and the high yield spread is very, very low. So on the surface, it does not look like there is really any pricing in of credit risk when you look at these really respected indicators of, strength or stress in the system. We have our own financial stress index, and those types of things are in there. The following essentially serves as a thoughtful brief on present dynamics in the private credit space, which we see as a potential economic red flag here. And I'll show you these charts after I'm done paraphrasing this narrative for you. So Endgame Macro on his or her Twitter feed, firms like Blackstone, Apollo, and KKR, these are stocks that are in the ETFs, whose charts I'm going to show you in a second, sit at the center of the leveraged economy. When their stocks roll over and sink, it's often because the underlying plumbing that supports their business with dirt cheap credit or with cheap credit, strong deal flow, and easy exits is tightening up. Think about how these firms make money. They buy companies with borrowed funds, refinance them as rates fall, and sell them when valuations rise. But now the math isn't working for them. The cost of debt is high and sticky. 10-year yield is creeping up again after a weak auction. And the economic backdrop from falling consumer credit to tightening logistics is hitting their cash flows. The combination suggests fewer profitable exits, fewer new deals, less performance-based income. Jefferies, for example, and I had their chart up yesterday. I didn't pull it up for today, but the chart is getting creamed. They're a good barometer for deal making in the environment, and they're taking a pretty massive hit. And the other day, and this is before today's crack in the markets, which I'm sure you noticed, they were down 8%. Now, it's possible, and I appreciate this, that it's just short-term positioning ahead of earnings or a rotation out of financials while traders chase the mega cap tech melt up. But when you zoom out, the pattern looks too familiar. And of course, we've done that, and I agree, it's a red flag. So while everybody's watching new all-time highs on the S&P, smart money's watching the cracks forming beneath. The kind of stress that starts in private credit bleeds into banks and brokers and so forth. So again, this was just posted yesterday, and it was earlier in the week where I showed you we have indeed been paying very close attention to developments in this space, trying to assess what their equities might be telling us. Also, Jim Bianco, just a few days before, copied and pasted what he had to say about JP Morgan identifying 41 stocks, AI-related. They are now 45% of the S&P 500, the usual suspects, NVIDIA, Microsoft, Apple, etc. ChatGPT was released on November 29th, 2022. Since that date, these 41 stocks have accounted for 70% of the move in the S&P 500. The other 30% came from the remaining 359 stocks. So, folks, that is remarkable. I keep saying we have not seen anything like this in terms of concentration in the market since right before the tech bubble burst. All passive index owners have significant exposure. So if you're buying the S&P or the NASDAQ or a tech ETF in your 401k, this is what you got, right? So clients, as you know, and I know you've been noticing, we've had a really an exceptional year in our core portfolio. The good news is our overall exposure to tech equities, and this includes global tech, is just 10% of our equity allocation. So we've been getting our gains this year from places other than what's been happening here in this gray shaded area. And believe me, that's nothing to feel complacent about or to take for granted. We think this market is just going to get more challenging as this late cycle extends itself. Today, for example, the S&P was down nearly 2.75%, and the NASDAQ 100 index was down 3.5%. So that's the biggest down day since April for sure. The VIX, the volatility index, it tracks implied volatility or the cost thereof in S&P 500 index options, was up 32% today. So that means that our put hedge on the S&P had a whale of a good day. Nevertheless, our core portfolio still was down 0.88%. So it captured a little less than a third of the overall move in the S&P and like less than about a fourth of the move in the NASDAQ. And that's something that we feel very good about given, our relative performance so far this year. But again, our portfolio is not entirely correlated, and this is on purpose, to movements in the equity market. So again, a lot to think about. I've talked about our dollar exposure and why this year is working so well for us. We've had kind of a microcosm in terms of the dollar's move of what we truly believe is the right long-term view on the dollar, and we think it's smart to position to that thesis, at least for now. And of course, we will change our mind if and when circumstances dictate. Okay, so to the charts, and just since I have it up, let's go ahead and look at that VIX. Remember, for the last few weeks, I've been pointing to this divergence. The VIX has been making higher lows while the S&P has been continuing to jump into all-time high territory. And we've been doing, this kind of work for a very long time and noticing, with rare exception, that this is a dangerous look in terms of the potential for a downward correction in the market. This was 21% earlier this year. This was, I think, low double digits right in here, so nothing huge. Same thing there. And then this was a pretty good move in late 2023, leading to this 30% decline in 2022 was, this divergence, if you will, here in the VIX as well. So basically, the underlying action in the option space suggests that traders are hedging against their downside exposure here. And this is that nearly 3% drop in the S&P 500 today, and this is that massive move in the VIX higher. You can see very similar look right here before the 21% decline earlier in the year. So we'll see how far this goes, and I'll probably get to what presumably was the cause of this today as well. Okay, jumping over here. So again, charts that we've been looking at. Folks, I've been showing you this gold miners GDX ETF chart. And right up in here, we cut our exposure in half. We have had a whale of a good time since we bought it in February of last year. We're still very bullish on the precious metal space, and that means on the miners as well. But technically, we thought it was ripe for a pretty decent pullback. So yesterday, we had a very convincing bearish engulfing candle. And folks, if you're bullish, you don't want to see this at an all-time high. What I mean by that is you see this blue bar, which is all of the trading open to close yesterday, and you can see that it engulfs multiple days going back, and it's at an all-time high. So it tends to be a pretty good indicator that more than just this one-day correction may be coming. And it broke down below the very defined trend line here. You got a big fat sell signal on the MACD, and it was rolling over already with a bearish divergence, as was the relative strength index. And today, the wick of the candle, or the shadow, the white part back there, shows the open to close, but you can see that gold stocks got bought toward the end of the day, and they closed pretty close to even on the day. But we'll see. This is a concerning chart right here. Right now, I'm feeling good about taking off a little bit of that exposure. We've also been talking about the small cap Russell 2000 index and looking somewhat optimistically at the nice breakout that we had here very recently. So here is make that line a little thinner here. So here is the level that we've been all the way back to 2021. So while the stock market people think is just ballooning to all-time highs, here's 2,000 U.S. companies that are sitting below where they were in the fourth quarter of 2021. And I say there's nothing worse than a failed breakout. We bumped against that resistance and then completely lost it earlier this year. And then here we bumped it, retested it, and closed a few days above it, and looked pretty promising that this might be support. Well, today, there was just a big panicky sell-off on high volume. So that saw that crash back below. So we'll watch the next few days. We've been incrementally adding to our small cap exposure. It's worked pretty nicely since we started doing that. And we're doing that so that we do have a little more upside oomph if indeed this U.S. market has maybe a few more months left in it, but not in enough size to, put us in any kind of significantly higher risk position because, we've rotated from other things to get to that position. So we'll see. That's going to be interesting. The point here by adding small caps is if we do have a big blow off top over the next, say, 3, 6, 9 months, there's some serious catch up that small caps still have to do. So if you're going to own something in that environment and you're willing to accept the volatility, small caps still represent some value relative, certainly to things like large cap tech stocks. Okay, so again, remember I showed you our ETF, or the ETF that we use as an indicator, that's chock full of these companies that are providing credit to startups outside of the banking system. Now, the thing is, the banks provide the liquidity to the companies that provide the liquidity to the business development companies. But it doesn't jump off the page front and center in terms of bank reserves and that sort of thing. So critics of this kind of analysis would say, hey, the big banks are fine. I would say, yeah, but they're not going to be if we continue to see charts like this. So this is, your KKRs and your Blackstones, et cetera, that are in that space. And just kind of take a look at this relative to the S&P 500, right? So here you have this space really beginning to falter even in 2024, but liquidity sloshing around, yada, yada. And you see it rolling over before we had that big correction earlier this year. And goodness, it's rolling over very hard, and it has been. And then here's that big off day that we had today. Same thing for private equity firms, right? They've just been running around buying up as much as they possibly can. And you can see that the private equity space stocks have been rolling over and showing some pain. So these are potential cracks, as I read to you in that narrative as well. Leveraged loan index, same thing. And these are things that we were looking back in late 2019 as we were had huge warning signs in the credit markets. It was also getting flagged by the Fed's own financial stability reports, which is a little more sanguine now than it was then. But the reports from like the Bank of International Settlements and in the International Monetary Fund are raising concerns about the state of the credit markets, particularly these under the surface, somewhat shadow credit markets, if you will. We looked at the VIX already, the S&P 500. Remember this long rising wedge pattern with these long bearish divergences. This was quite the breakdown today. That's a massive sell signal there. It's with momentum. You break that 50-day moving average on Monday or Tuesday. Technically speaking, you could see a serious correction right here. Sentiment was very, very positive. The weekly advisor sentiment index, the bull-bear spread was very much in that dangerous territory. And it just interestingly happens to be when we see some pain at these levels. Now, if over the weekend, the headline that really got the market freaking out a bit gets retracted somehow. So essentially, China has tightened up the supply of rare earth minerals that we need, that only they can supply at this point. And the president really reacted to that and said, okay, that's too bad because we were supposed to meet soon. So what we're going to do now is we're going to put 100% tariffs on China. So, of course, Chinese stocks had a terrible day today, as did the U.S. So if over the weekend there's not a walking back from either party on that, we could wake up Monday morning with some more pain. And folks, again, the charts are suggesting that that is inevitable anyway, and the valuation setup and so forth is messy right here. Now, October is historically the most volatile month of the year. The average move in the month of October for the S&P 500 is 0.89% historically. That is a big daily move. So we were going to get some volatility anyway if seasonal patterns were to play out. This does not mean that the bull market is over. I do think it will end, and I think that may not be in the far distant future, by the way, when we look at all the things that we look at, but we're not taking anything for granted, and we're not really betting on that right here. In fact, I would still argue that for the remainder of 2025, you could very well see more of this buy the dip. Right now, though, there is enough, whether it's rhetoric or reality, to get this market somewhat worried. And anyway, we saw that expressed today. Of course, we saw it in tech stocks in a big way. A massive move blew right through that 20-day moving average, which has been a very important support for the NASDAQ 100 index. So again, rough day, closing at the lows, not a good sign. Gold actually held up today. It was kind of all over the place. You can see gold had a big bearish engulfing candle, engulfed the day before, but it did fill that gap yesterday. Today, it opened higher and kind of played around in this range right here. So it was up a little bit. Gold miners were actually down a little bit. We'll see how that plays out. We are very bullish, as I say all the time, on gold on a trend basis going forward. We think that a sizable correction is certainly a distinct possibility right here. The charts are very much calling for it. So today we took this opportunity on the upswing to move our hedge a bit closer to the money to mitigate more of that downfall than we were previously, because the price has pretty much run away from the strike on our hedge. So anyway, I know I'm getting into the weeds, but we want to protect that position that's been so phenomenally good for us right here. Folks, remember back in here, I was telling you that the whole world is short the dollar. In fact, I was showing you the futures net positioning among different classifications of traders. Literally, it was right in here. And lo and behold, boom, we had this short covering rally, I would call it. Today is interesting, right? So today was a day of mass uncertainty, right, over the headlines that I discussed. And traditionally, the dollar actually rallies. It's kind of a safe haven currency, on bad, scary news. But remember, we've been talking about the yen, which we have a position in, and how that I think the yen will basically play that role, given how global positioning is, and notwithstanding the dynamics in the Japanese economy, that we think over the next year plus equate to high odds of a higher yen. The yen was up 1 full percent today against the dollar. So the world didn't come running to the US dollar. The world went running to the Japanese yen. And we've talked about the carry trade and that dynamic and why that makes sense to us. And I'm sure we'll talk about it more when I have the opportunity, or when it seems like a good topic to discuss. So the dollar sold off today, and bonds got bought with both fists. So U.S. yields dropped like a rock today as bond prices rose. So people certainly bought Treasury bonds today for protection, but ironically, that wasn't money flowing into the U.S. to buy those bonds. And lower yields, all things equal, would equate to a lower currency when you think about interest rate differentials. So folks, before I edit it, that's over 20 minutes, so I will just stop right there. There's going to be loads to talk about as we move forward over the next few weeks and months. Thank you, as always, for watching and listening, clients. This will hit you tomorrow morning in your email inbox. And I hope you guys have a wonderful weekend. Take care. Bye-bye.